Well, that was a bit of a disaster. The US just held its 20-year auction, and let's just say the results weren't so great, with spikes being caused across the board as markets looked for high yield to take on the risk. And as we expected, dark pools were ahead of the game, and in today's video, we'll take a look at what that means as Wall Street potentially set up to sell into us as retail traders. We're the most leveraged we've been in a while. We've seen a huge amount of money flow into alternative assets, and that could be still just getting started. Bitcoin is at all-time highs. Guys, join us as we cover stocks, commodities, and cryptos in what is going to be a very special video. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. The latest macro, the big data, and of course, those dark pool trades from Wall Street. Just a quick shout out. I know a few people were wondering where I was. Unfortunately, I felt quite sick, but we should be back to The Daily Shows for now. So thanks for sticking with us. And of course, if you wanted to get a couple of updates, I did post over on X, links in the description down below. So as we've been warning and talking about, we saw the market, we saw Wall Street move defensive over the last 3 to 4 sessions. Now, what that means is they started going into bigger defensive stocks, things like utilities, staples, and healthcare. And we'll look at that a little bit later on, including gold. And they were looking into alternative assets. But let's kick things off here with the pretty bad US 20-year bond auction. And this could be a precursor of what's to come in the third quarter of this year. Demand kind of collapsed during the session. Yields had to spike, and it was one of the weakest auctions in years. And this basically means that markets started to get a little bit worried across the board. And more importantly, they're demanding higher compensation. And it's not just in the US that we're seeing this. Take a look here at Japan. The 30-year bond yield is going bonkers right now, back up to 3.13. And you might say, well, this doesn't mean anything, whatever. You know, we've seen these types of big rallies before. But this is part of a bigger problem. We've got more debt than ever before. And remember, the US has to actually finance that debt third quarter, fourth quarter, and early 2026 with huge rolls that are coming. So the question then becomes, have we hit a recession? Well, oftentimes, whenever we're looking for a recession, guys, we're often looking and seeing whether there's any signs of it happening underneath the hood. Now, generally, the street, of course, that is the Wall Street, they'll be ahead of us, and it'll show in the flow and it'll show in the dark pools. But take a look here, at least from March, and you can see here that most states were actually doing okay. I want to alert somebody, you guys, to this, I guess, but it was just to do with Jamie Dimon, who's obviously the CEO currently of JP Morgan. Firstly, it looks like he's going to leave. Secondly, he said it's getting ugly out there. And of course, he's sold some of his stocks near the high. Now, we just recently got some filings that showed that Warren Buffett has also sold more banks and particularly deleveraged his bank positions even further. So what is this telling us? Is there something wrong in the system? Is something incredibly sick? And these guys know, but of course, timing will be everything. Are they earlier to the game? Well, we kind of suspect that could be the case. And of course, it may be that it's 2025, but probably is going to be 2026 where something really bad happens. And while we expected 2025 to be tough, we thought we would hold out until the third quarter, fourth quarter in terms of still seeing some form of up, down, all around market. And you'll see why we could still make an all-time high very soon for a couple of valid reasons. Now, a lot of people have worried about treasuries and saying, oh, the liquidity is dead and everybody is all owned by overseas and it's really bad. Well, actually, only 33% of the US treasury market is owned by overseas. Financial sector owns, of course, a lot. Government owns a lot. Households own a lot. And then some is owned by the pension funds. But what is the most likely path we're on? Well, we've got two kind of scenarios here for the paths. And the first one is, of course, what we're seeing from Trump's administration so far, which is, of course, that we had a 20% fall off thanks to the tariffs and some other stuff. And then since then, we've rallied up as some of those have been relaxed. Now, funnily enough, this happened when we saw a few other presidents that had some pretty big reforms. And we actually saw rallies to generally sometimes all-time highs during that period. But then something weird happened around 200 to 250 days. And we started to really fall off, or in the case here of Ford, we actually went up and continued to rally. So something, of course, you could be watching and looking at. Now, as we mentioned, the defensive actions here were pretty big over the last couple of days. And yeah, we saw 5-day rotations into gold, massive spike, 5-day rotations into Bitcoin, massive spike. 5-day rotations into staples, utilities, and healthcare, massive spikes. So all across the board, they've been up. And this shows really in the last 24 hours of trade as well, where we have, fall offs across really a lot of these other sectors, such as KRE, which is more sustainable to these high yields, and even financials. So there's a couple of problems there that are starting to occur. Now, when it comes to big dark pools, guys, you guys know that we always look for these. And when it comes to dark pools, we're always looking for those large transactions. And we did see some clusters here that continued to spike the same level. So we have the line in the sand. It's 522 on the Qs. You can see here so many transactions coming through. And while none of them in particular were that large, it was the combined brute force of probably the algorithms on that level that really caused it to go through. And I shared some of these in our private group, as of course I wasn't well enough to do the videos. But basically these just show exactly what we already suspected on our weekend video, which was our last one here on YouTube, where we started to think that we were at resistance and we might see some dark pools. Well, as it turns out, we did see some dark pools, and you can see here that we've had those transactions through those same levels. So does this mean that it's all over? Well, actually, smart money started to increase its bidding over the last couple of weeks. And of course, they bought mostly all in that one session where they went bang and they just basically super bought up. And that was during the peak of fear. But they've started to add little bits, as some of them are probably trying to play catch up to the markets. But that doesn't mean that it's not at some form of temporary resistance from now. Bullish percent index, one of our favorite reads for the S&P, and bullish percent index for the NASDAQ both show overbought action. And of course, the RSI also shows the same thing. And even equity margin has now already spiked all the way back up to the peak before we saw kind of the sell-off here earlier this year. That basically means more people are levered than ever before. More people are feeling absolutely great about buying the dip. And we actually saw the fastest ever buy the dip on Monday by retail. And we know that this is a retail net imbalance because effectively retail is purchasing in these periods of time, and that's where the flows are coming from. We just saw $4.1 billion on Monday, which was the biggest midday buying spree ever. So could it be that Wall Street wants to trap some positions here? Maybe say, you know what, haha, you bought the dip, we push you down, and then maybe we rally later. Well, of course, they love doing that. So this is, of course, one of the things that we could be looking at. But in general, we're following probably the most closely now, still either the kind of 96 scenario, or not really exactly the 98 scenario anymore, but still the possibility of being there in the cycle. So effectively, we're at these kind of points in markets at this stage. Some good news is we were led by semiconductors on the way up, and technology. Obviously, we know that is a big sign. We've talked about that before. And of course, earnings is still going on. And so far, this earnings is pretty good. And it really just matters about the next earnings and how that goes. Obviously, that's going to be the big key influential point. When it comes to big markets here, guys, big central bank equity and flows, it doesn't seem like liquidity is being pumped in anymore. So for about 2 weeks now, we've actually seen a lack of liquidity from the street. And this is coming from, of course, the Fed and other central banks around the world. And that also may take a little bit of a dampening effect here, where we could see the markets pull back. And the question is, where will these markets pull back to? Well, ideally, they at least make it back down to the 5,600 to 5,660 zone. And you'll notice here there's a big gap fill sitting around 5,660, which comes off the US-China trade deal being announced. And obviously, there's huge gaps that have been left from a couple of spots. Now, gaps don't have to necessarily fill, but as we've talked about, we've got anchored VWAP, we've got a 50-day moving average, we've got a 20 just above it, we've got Fibonacci, we've got plenty of things. We've also got one of the most traded zones throughout this whole range, which we've talked about several times over. So we've got a lot to like about this 5,600, 5,660 should the markets come back. It also just happens to be around the same point of fall that we saw during the last downgrade of the US. So obviously Moody's downgraded the US recently. And the last time we've seen downgrades, one of them was a big fall. And the second one we actually saw around a 5 to 6% drop, which actually takes us to around that 5,600, 5,660. Now, in both cases where we saw downgrades from these big banks and financial institutions, what ended up happening here was that we ended up at all-time highs, and we ended up actually very bullish after that. So it's not that a downgrade necessarily has ever led into a massive crash straight away or anything, but it has led into sometimes a catalyst to create a pullback along with some of the other things that we've got going on. So let's have a look here at what's going on with the S&P 500. You'll notice straight away that we have a market that has gone from a series of higher highs and higher lows being completely up in the trend and has literally not changed this since we broke out from the US-China trade deal, and it suddenly made a lower low. Now, it's sitting right on a put wall, as you'll see in a moment, but we did break underneath 58.80, and it means that if rallies do occur now, there's going to be a lot of fighting around the 5,900 point in particular. And what we can do is we can actually take a fixed range volume profile, and we can have a look here at this range on the way down and recognize that there's a few different zones that we could be looking at. So of course, there's a lot of trade here at 59.50, which makes some sense. And then if we pull this across, what we'll notice is we have a ton of trade, and this is the actual level I was looking at, 59.13. It's about right. So, we could be going to somewhere in between here, and this is where the bears will want to basically recommit if they're going to, in terms of trading to the short side. And there might be a few reasons we could still rally here today, over the next session anyway. And that's because options high level is about 5,900. And if you actually look at the puts, take a look how many puts there are here. If we drop 58.50 over the next 24 hours, that can create what we've seen before, which is like a waterfall or a cascade effect. And these cascade effects, as you guys know, can cause very quick, sudden movements, which can be kind of like, 2, 3, 4% in even a session, because all of a sudden there needs to be so much hedging done due to the massive amount of puts that suddenly start to appear. But what you can see is we've entered back into negative gamma as soon as we break through that level. So effectively what's been really, really positive, everyone's been trading to the upside. We see one bad day, one bad session, and all of a sudden everyone wants to buy puts, which is always a little disturbing if you are looking for that pullback in markets.
Tesla CEO Elon Musk expressed confidence in a rebound in demand for the company's vehicles, despite recent disappointing delivery figures. TSLA stock has surged over 40% in the past month, although analysts maintain a neutral stance with a hold consensus rating. Musk's statements come amid rising competition and scrutiny of his influence on sales. NVIDIA's CEO criticized U.S. chip export controls for harming business, while analysts anticipate a positive first-quarter earnings call despite significant revenue losses. Concerns about competitive pressures and potential AI bubble risks remain. Microsoft Corporation is facing employee protests over email censorship linked to its contracts with Israel, while also conceding $115 per megawatt hour in a nuclear plant deal. The stock fell by 1.22% amid these controversies.